All right, welcome to another episode of the Pinpoint Investor with Faisal Morsi. My guest today is Jeff Ervick. Most of my guests so far have been friends of mine, and so I know exactly what they do, and the conversations have been pretty much how I expect them to go.
Yeah.
Jeff and I met at a meetup. It was actually a fundraiser for his son's baseball team, and I found out he was a multifamily investor. So I was excited to talk to him and learn from him because most of my friends and guests have been single family investors. So hopefully we're going to learn a lot about multifamily and raising and deal finding today. So appreciate your time on today, Jeff.
Yeah, excellent. Hey man, I appreciate having me. Excellent. Yeah, so it's funny is at the baseball tournament, obviously we didn't meet, we didn't know each other, but our mutual friend Sean introduced us. And it's funny enough, Sean's actually the one who got me into real estate back in 2017. So it kind of brings it full circle, right?
Nice. That's awesome. Yeah. Shout out Sean Magner, Monument City Capital. If you're ever near a hard money lender, reach out to him.
Yeah, for
But give me
sure.
an idea, Jeff. Like, what do you do? How'd you get to where you are?
Yeah, so I've been in technology sales for almost 20 years, right? And through all that, I've always decided that I wanted to be a part of real estate. I wanted to own real estate. So I got into kind of my backstory. So funny, like I mentioned to Sean. So I met Sean in 2017. One of my fraternity brothers at Virginia Tech went to high school with Sean. So he's like, "Hey, you need to meet Sean, and he's into real estate. You go meet him up in Baltimore City." One of those things. So we met for coffee. And he brought me to a couple of different meetups back in 2017. Ended up getting into real estate that way. Found my first property in Dundalk, Maryland, through one of those live auctions. Right, so we're literally 30 people around this townhome and raising up hands and that kind of stuff. And eventually, I won the property. Figured out how to get into it, how to flip it, or how to rehab it. I did the Burr method on that one. So, buy, rent, buy, rehab, refinance, rent, repeat, and so forth. So that was interesting. But that's how I got into real estate from that point. And since then, I've always wanted to get up and scale and buy bigger apartment complexes and so forth. So that's kind of recently, with the last 13 months, got into buying multifamily properties. But it's been a good journey so far, but there's a lot. Obviously, I left out in between there. I can go into detail if you want to, which I hope to do.
Yeah,
But
absolutely. Don't hold
that's
back.
how I got into it.
Nice. All right. And so, for me personally, like I'm still a single family investor. How did you make the transition from single family to multifamily?
Yeah, it's really about finding a team, right? Finding in the partnership, understanding people who can do different things. So multifamily invest. So as a single family investor, you can do it by yourself, right? You can find the property, you can hire the contractors, you can manage the property, you can find the renters, you can collect the rent, all that kind of stuff. But in multifamily, it's we call it a team sport, right? So there's multiple people involved in an acquisition. That goes from talking and meeting with the brokers, from underwriting the property, getting the property under contract, working with that. So knowing that whole scenario, then going through once we have it under contract, we do due diligence. So we go out and we visit the property, make sure we understand where and what it is that we're going to be buying. And then through that process, we raise capital and then we close the property, and then from there the business plan happens, and then we have a whole team of asset managers and property managers. So it's not a single person, or a not single person, it's not a one person business. Like, you have to have a good team. And so that's what I've gone and went out and find. So I wanted to scale. So I'm like, I need to go find a good team. Went to a couple different masterminds, joined a mastermind program about multifamily investment. And then from there, met my teammates, and we formed Valoris Capital Partners. And from there, we've been off and running. So it's been a fun journey so far. Yeah.
All right. And so you decided you wanted to, hop into multifamily. And so you joined the mastermind first?
Yeah. So join the mastermind to really just understand the dynamics of buying an apartment complex, right? Because it's not something you can just jump in and say, "Hey, I want to go buy that 150 unit apartment complex," right? You really need to understand the business, understand what it's all about. And from there, I joined a multifamily mastermind program, met my teammates. So basically, I joined it as knowing that I wanted to find a network of people, right? Network of people who want to get into multifamily or were already in multifamily. And that is the best and easiest way to do anything we do, is by networking, right? And that's a huge aspect of this business, is networking. Being able to find that team has been crucial to my success to be able to continue to grow.
Yeah, absolutely. And so a lot of these like multifamily masterminds or just masterminds in general are funnels for coaching. Did you then sign up for coaching as well through that, through that
Yeah,
path?
you're right. It is, and that's I knew going into it that it was one of these coaching programs, which is fine, right? I mean, obviously you got to get your start somewhere and understand where, what the specifics are, right? So went through the coaching program, and but really I joined it mainly because of the network, right? I knew there was a lot of really good, high level successful people in that partnership, in that network. And so being able to join that has been a huge success for us, right? So the coaching side is excellent, and you learn about it. So coaching is really good for underwriting, acquisitions, asset management, in the capital raising. You can do it for capital raising side, but really capital raising is just about people and relationships, right? And that's really what I've always been doing for the last 20 years, is in sales, building relationships, right, with my customers, and then continuing to develop that relationship over time, and let them know that I'm a trustworthy person, right? So through my actions, through my business transactions with them, becoming their best friends, right? And that's really what I focus on, is really becoming friends with all my customers.
How did you vet and research the mastermind and the coaching group first?
Well, I went to a bunch of seminars, right? Went to a bunch of different aspects, or different networking events, and asked around. I met a bunch of different folks and so forth, and just kind of really vetting out which one I wanted to get to. And then from there, I joined up, and the rest is history, right? So yeah.
Nice. You talked about capital raising. Without a track record, how were you able to, I mean, obviously trust and like, relationships, but how were you able to like prove like, hey, I'm gonna like, actually be a good steward of your money, even though I
Sure.
have no experience.
Yeah, yeah. Well, so I've had real estate experience. I've been in real estate for since 2017. I flipped some homes. I currently do have a portfolio of single family rentals myself. And speaking of Sean, I actually am one of Sean's capital investors in his hard money business. So I've done hard money lending. I've actually done private money lending out of my own self-directed IRA. So having that background of a core, I guess I call it, right, of the real estate background, has helped with my experience in the multifamily side. But in turn, also, we partner from the beginning. We partner with very experienced operators, right? So folks who are 50, or I would say even 200 to $300 million of assets under management, have been doing it for 5, 10, 15 years, have gone through those full cycles already of selling opportunities, selling deals, gone through the downturns and so forth. And we lived through the downturn, right, in 2008, and obviously we're in one now, right? So that's been helpful, right, to have that as well too. But the partnerships, as I spoke about earlier, that is key, right? So knowing that we are partnering with the right operators, and you got to vet them, right? So you got to vet the operators, you got to do your due diligence, you got to call around, basically like asking for a referral, right? You got to get a referral, and then you got to dig in and ask, make sure you're partnering with the right folks. And we've had some really good success in that space, being able to partner with folks who have that experience, and that's gained our experience, right? So through that, our company has gained tremendous amount of experience when it comes down to operating the deal, or finding the deal, vetting the deal, underwriting the deal, and then operating the deal, right?
Nice, that's awesome. Walk us through that first deal. How did you find it? How many units was it, and all that good stuff?
Yeah, so first deal was 128 units in Arkansas, right? So we had an Arkansas property. So that one, again, we joined a partnership of very experienced operators. We joined up as helping to find investors, but also put some of the asset management as well too. So being able to kind of counteract both of that, right, has been crucial. I've got in like I mentioned earlier, in a team sport, right? My partners, one of my partners handles the operation side of the house, so to speak, right? Where I'm helping out doing the investor relations and finding the investors. So being able to be a part of that. Now we jumped into that one back in June of 23, right? So right out of the gate, we met this partnership and jumped into the property with them, helped raise some capital, and now we're helping them operate the business and we've got a pretty full marketing staff behind us too, within our company. So helping them do marketing and all that kind of stuff has been helpful.
And so my understanding, again, it's a very limited understanding of multifamily. So it's to find distressed properties, or find distressed multifamily properties and then add some value. So what was the distress there? Was it just under market rent or just not not enough like apartments filled?
Yeah, so our business model is the value add, right? So value add, distressed properties, neglected properties, the biggest one I feel is just like in even the storage side, right? Is mismanaged properties, right? So people who don't pay attention to the property managers, because your property managers are the lifeblood of the property, right? They're the ones who are interacting with the residents day in, day out. They're the ones who are collecting rents. If there's evictions happening, they're filing that paperwork. They're trying to ensure that you lease up the property as well too. So if you mismanage your property managers, right, or you let them neglect the property for a certain amount of period of time, you're going to find yourself in a hole, right? So that is the biggest aspect, is really managing those investors, or managing the property managers on site, right? Making sure that they're following your business plan and they understand what that's going to be. So our core, right, of Valoris Capital Partners is the value add properties, right? But we've also we've added some industrial as well, which we're very excited about, like light industrial, flex industrial. And then we're also doing ground up development, right? So, and again, those are two different avenues where we weren't expected to go into, but we've met such great partnerships. There are people through our network that are experienced operators in the industrial side and very experienced operators in the ground up development side. So we've kind of got a three-pronged approach right now to our business, with value add as the core, right? Value add multifamily as a core, and then having the ground up and the industrial kind of flanking it, so to speak.
Nice. Okay, so you talked about team, and you mentioned property managers. I think that's the one that people are most familiar with because it's front facing. What
Yeah.
other aspects of a team are there?
Yeah, so for us, our team consists of acquisitions, right? So acquisitions is investing in the relationships with brokers, right? Finding the brokers, understanding where the properties are, whether even if it's an off-market property from a broker, right? Because a lot of times you'll find the information on Crexi or all those areas, right? Which those properties are already kind of passed through the people who are the back pocket listings, so to speak, right? Once we find the property, we've got underwriters, right? So folks who actually go out and underwrite the property. Well, they don't have to go out and do it yet, but they get all the information. You get the rent rolls, the T12s, the T3s, all the expenses, right? We underwrite the property, right? Make sure it's the right fit for our business model. If it fits that model, we then go even deeper, do a bunch of market analysis. We'll fly out to the property. We'll visit the property itself, walk through the property, meet the brokers in person, make sure it's what is advertised, right? As far as the location, the condition of the property, the tenants, make sure we kind of we'll even secret shop it, right? Go and ask, the current tenants or the current property management what they love about the property, how many is open, all that kind of stuff, right? So that's what we call acquisition side, right? Is finding the deal and then underwriting the deal. Then we have investor relations, right? So investor relations is building up our investor pipeline, raising capital for the deal, continuing to have conversations with investors, make sure we send out not weekly, but monthly newsletters. That's a big thing. A lot of people love communication, right? So if you're taking someone's money, right, and you're going to be helping invest with them, then we want to know, right, what's happening with my money. What are we doing with it, right? So having a solid investor relations team has been crucial. So there's a couple guys on our team that do that. Then we have asset management, right, which is another core component of it. So asset management is after the property has been acquired. That is the person who, or the team that implements our business plan, right? So making sure that what we've underwritten the property for, right, what our value add or our strategy or our plan is to appreciate the property, or what I love to call force appreciation, right? So basically not just letting it appreciate over time, but implementing value add strategies like updating the units, doing unit turns, adding new appliances. We even do any exterior modifications, make it beautiful, add new parks. And we have a property in Jacksonville. We're just finishing redoing the pool before summertime to make sure the pool is ready to go for the tenants or for the residents that we live there. And that's a big part, right? We do partner with third-party property management firms, but one of our other partners actually owns a part of that. So part of our strategy is to eventually have a different business silo too, which is going to be, owning a property management firms in the future. So those are the kind of the team, so to speak, that we've put together. That is crucial in making sure the business goes according to plan.
All that kind of seems overwhelming. And so
Sure.
yeah, so like when you first joined in that like mastermind and coaching program, I'm
Yeah.
assuming a lot of those pieces are already like not in place necessarily, but like in that group is where like you meet all those people, correct?
That's correct. Yeah. So kind of the backstory, right, of Valoris Capital Partners. So I went to an event in Washington, D.C. It was actually in Northern Virginia. And from there was 150 people in that room, right? Understanding, trying to figure out what the scenario is, how to get in the properties, how to buy, meet people. My goal when I went there was to meet as many people as possible, right? So I immediately, if there was a question to be asked, I was up there, I was standing up, I was spitting out anything I knew, right? Just whether I knew it or not knew it, right? I was trying to participate and make sure I was vocal. From that, a guy came up to me and said, "Hey, I love what you're saying, and we should definitely have a conversation after this event, right? To make sure we, to meet each other and so forth." And just so happens we live 20 minutes away, right? So that was my partner Claudio. So Claudio lives here in Maryland as well too. So we met, we started talking together. We joined up on a deal, and through that other deal, we actually met our other two partners, right? So one of the partners brought us in. He's actually a coach for the multifamily coaching program, right? So he knows his stuff, right? Being that you're a coach, you got to know your stuff, right? So he's one of our coaches. Well, one of our coaches is one of our managing partners, and then our other partner, Ritesh, is one of our investor relations managing partners, like myself as well too. So the four of us kind of came together. We said, you know what? Instead of doing this separately, let's do it together, right? Let's bring our force together, right, and build a machine and have this machine be something that's going to be able to provide amazing returns for our investors, but also more importantly, provide an amazing place for our residents to live, right? Because that's an important thing. We always talk about real estate investing as how do we make money, right? Or how do we grow wealth and so forth. But we got to take a step back sometimes and remember we're doing it for, yes, for those reasons, but we're also making sure we make a better place for people to live. Quick story on that. So I was visiting we have a Jacksonville, Florida property, right, which is one of our key markets that we're honing in on. It's 128 unit. It's a value add property. It was think of your Baltimore City rundown property, right? But not in Baltimore City, right? In a nice area. And that's what it was, right? It was the ugly duckling on the street, right? Or it was the eyes, literally the neighbors called it the eyesore of the community, right? And we looked at it and be like, I love that, right? Because I know we're gonna be able to fix this thing up, make it a better place for people to live, and make it better for the community, right? Which is key. community is a huge aspect of this, right? And so being able to find that property, and we've been over the last 6 months, we've been implementing our value add strategy. We've been able to increase the occupancy. It's up to I think mid 90s right now. So we're starting to do big turns for all the property or all the units. We're doing those.
Where
We're
was it
about
when
to
you first
do.
bought it, if you don't mind me asking?
I'm sorry, what?
Where was the vacancy rate when you first bought it?
It was down in the probably in like the mid 80s, right? Well, actually, when it was at this is another key aspect to multifamily, right? Because when you're buying a property, you want to know what the current occupancy rate is, right? Well, advertise is going to be different than what is actual, right? So it happens a lot, right? When you buy a property, or when you go through the underwriting of property, it'll be like 90 something percent, right? And when you get in there and actually dive into it, then you realize that 90% is kind of more like in the mid 80s, and because the current property management or the current ownership just didn't really follow through in the last like couple months. They had it under contract, and let a bunch of like leases lapse, or people weren't paying, the property manager wasn't caring, and so we came in and had to reverse that mindset, so to speak, right, of the community, and say, hey guys, no, you still have to pay rent, right? If you don't pay rent, you won't live here anymore, right? So we had to get into a better habit with our with the residents to make sure that they were, paying rent, or we would find a new person, right? Or find a new tenant. So now we've grown it over the last 6 months up to mid 90s. So it's about 90, I think it's about 92 or 93% ish, right about there. And we're hitting strides on our value add plan. So we're about to do a big rebranding on that property, which is going to make it just an amazing like anchor in this community, right? And that's going to be exciting. We're really excited about how that happens soon.
How long does it take to do the due diligence typically on like a big property like that? And I don't know if I asked, how many units was it?
It's 128.
Okay,
128.
got it.
So the due diligence period is usually it's a 7-day period. Usually we have like 7 days, but typically that happens in about 2 or 3, right? So we do our normal due diligence, right, as much as we can through the underwriting process. So checking, like I said, the secret shopping, calling around other properties, getting rental comps, driving the property, touring the property as much as we can while we're trying to underwrite it, while we're in the midst of the putting an offer in on the property. Once you have an LOI in and accepted, right, then that's when the true due diligence happens, right? So then we go through and we say, hey, we're going to have a team come out, right? So we'll have, whoever we're going to use as our property management firm. We've got a couple that we use that are really key properties. One in Jacksonville is actually a local company. We'll have them come out and we'll inspect and walk through every single unit, right? So we'll make sure every unit is reviewed and noted as far as which one needs to be turned, which one's a classic turn, which one's an upgraded one. Maybe there's a premium section that we want to update, and then we'll have roofers out. We'll have all your trades, HVAC companies come out. We'll have construction companies come out. Paving companies if it needs to be paving, electrical companies, and plumbing. Plumbing is a huge one, right? Because sometimes the buildings we're buying are in the 70s, mid 70s, and back then, plumbing codes weren't as well as they are now, right? So scoping all the plumbing lines out to the sewer is key, right? So that way we don't have any issues that come up later that we did not underwrite for or account for in our value add strategy. So usually that process will tell us, all right, we did account for enough of money for our capital expenditures, our CapEx projects, or we need to go back and maybe retrade with the sellers, right? That, hey, this roof that you didn't tell us about is 20 years old and it's leaking in 15 different spots, right? So we need to make sure we have all that information done. We tried not to retrade, right? You want to make sure you keep that to a minimum, unless it really, really is imperative or we did not account for it in our underwriting. But we're always very conservative in our underwriting process. meaning that we account for high turnover in the first year, so high vacancy. Loss to lease will account for major loss to lease, which is basically the amount that we are not charging in rent versus, or the amount we're charging in rent versus what we should be charging in market rent. So all of that kind of together, plus cap rates and all that kind of stuff, makes us we really make sure we have a very conservative model when it comes down to it. So that way, when we get to the property and we start implementing our value add strategy, we get to a point where we can under promise from the beginning and then over deliver, right? That's a huge thing with any investment. But our investments are very strong, right? When it comes down to return aspect, anywhere usually a 20% average annual return over the life of the property. And we want to be able to hit closer to 25, 27, right? But we're going to have to make sure we under promise and over deliver those.
So help me understand that aspect of like getting your money back to your investors. So
Sure.
let's just use fake numbers here. Let's say the purchase price is like $10 million. And how much of that do you guys have to raise? How much of that have you raised beforehand? And how do you calculate how much return you're going to give to your investors? And then what's the exit strategy there? Is it just refinancing, or like are you selling it in a couple years? Like all that.
Yeah, sure. So, so in that scenario, like a $10 million property, we'll typically look for about a 60 to 65% LTV, right? Loan to value. That will keep us in a good range of a lower debt, right? And the lower debt numbers. So if we're doing that, let's just say, we're raising 4 million for a down payment, plus closing costs, another 500, and a couple of acquisition fees, and a couple other fees that are in there. Plus the value add strategy. So let's say it's $1 million for the value add. So we're probably raising close to 6 million or so for that type of property, maybe a little less, 5 to 6 million. Again, it depends on the level of debt that we're going to get, right? And so we have relationships with lenders, right? So that's a huge thing. Again, just like the brokers for buying the property, we have to have relationships with the lenders to make sure we understand what the debt is going to be look like.
And are these
And even
private
today,
lenders or institutional lenders?
no, it depends. So it depends on the property, right? If there's a lot, if it's a heavy value add property, sometimes the institutionals like the Fannies and Freddies and so forth won't touch those really. So we have to get with a bridge debt, bridge loan. And we've been looking at very fixed rate bridge loans. You see out in the news everywhere that multifamily or commercial real estate is going to be crushed. There's going to be a lot of foreclosures and so forth, or people are in trouble right now. That's because they got in 21, 22, they got floating rate debt, right? So they got floating rate, so they were able to get it in at and underwrite it for 3 to 3.5%, right? But now that's closer to 7.5, 8%, right? So they can't make their debt service, right? Which is why you'll see. I think probably closer to early to mid 25, you'll see some of those happening, right? Some of that happening. But ultimately, yeah. So our loan to value, roughly 65 ish percent, sometimes 70, depends on the property. And then we're raising for the down payment, we're raising for the closing costs and that as well. So the typical hold time for us is usually on average about 5 years, right? So that time frame will be able to appreciate the property over time, so the value will go up, but we're going to force the appreciation up front, right? So in order to do that, we have to obviously implement our value add strategy, which is why we have to raise for the capital equity, right, for the property, and we will force that appreciation, make that net operating income go up, increase the rents. At the same time, we're going to decrease the expenses, right, by managing it much better than the current management was doing it. So we've got a very, very, very good finger on the pulse, right, as far as how the property is operating on a weekly level, not even just a monthly level, but a weekly level, right? Making sure that if we're collecting rents at a certain time, if not, our property managers are putting in eviction notices or getting through that as well too. So by doing that, we're going to increase the value of the property, the net operating income, decrease the expenses, which will then exponentially increase the value of the property. So Commercial real estate is a little bit different, or multifamily real estate is a little bit different than your single family home, right? So you can value a single family home based on comps, right? So, hey, my house, I bought my house for 500 grand, right? So my neighbor just sold their house for 750. So my house is worth 750, right? You can't do that for commercial real estate. You can't say, hey, that building sold for, 100 grand a door, right? For a 130 unit door. So 13 million. So ours is now worth 13 million. Well, that's not how it works. It's based on a business. So really you're operating a business, right? Of real estate, right? So really that's the key. And if we can operate that business efficiently and effectively and move through our business plan, then our property will not just increase by a couple 100,000, it's going to increase by millions of dollars, right? So over that span of that 5 years, right, there might be a refinance in there. If we do that, we'll bring back the capital to our investors, right? So for example, year 3, we might refinance it if we've got good rate coming up, or we've got the property stabilized where we want it to be. So we'll refinance. We'll on average, I would say probably bring back 50 to 60% of the capital to the investors while they're cash flowing. And then year 5, we'll sell the property, bring the rest of the capital back plus equity. All along the entire time, we're also going to be cash flowing the property as well too. So our cash flow is annually roughly about, I'd say anywhere from on average 8% cash flow. And then the average annual return over that, which includes the sale of the property and everything, is 18 to 20% annual return. So roughly about a 1.8 to 2.2x multiple on your money.
And so people are
That,
getting monthly payouts or like quarterly
we
like
do.
dividend payments. How do you pay your investors?
Yeah, it's quarterly, right? So we'll pay quarterly, because a quarterly payment, distribution payments, which will go against a preferred return. So typically we'll have a preferred return on it. So let's just say it's a 8% preferred return. The investors will make their money, and it's cumulative, right? So it over the lifespan, we'll make sure that they get their 8% before the general partnership gets paid. Then from there, we split it on average, 70-30 split. So the investors will earn 70% and of the cash flow, and then the general partnership will earn 30%.
And
And
so
that's the
you
same
guys,
once we sell it to.
so you guys basically get 30% for managing their money and the
Yeah.
asset, correct? Okay.
Yeah, exactly. And we actually invest in all of our deals, right? So our team invests a significant amount of money into every single deal we do. So we're not just asking investors to, invest in the deal, like we are investing alongside of our investors, right? So building up my personal portfolio, right, of multifamily real estate or commercial real estate in general has been a very big aspect for me, which is again why I got into this in the first place, because I wanted to scale, I wanted to buy bigger properties and so forth. So I'm investing in every single deal we do. And then our partnership also, so the general partnership that's made up of all of our teammates, everyone is required to put some capital in there as well too. So that way there's skin in the game. And that's, I think, a big aspect is having skin in the game, not just sweat equity, right? But having actual cash into the deal helps all of us make sure that we're doing what is appropriate for the property, right? And as well as our investors' money, because that's a big part is how do we make a good return for our investors? In the same token, running a good operating business and building a great community. I think that's a huge aspect of work too.
Is that 30-70 split typical or?
Yeah, we're actually we're looking at even increasing that a little more, 80-20 potentially, right? So we well I know we've got a lot to talk about here too, but our company we're about to launch a fund. So our first value add fund is going to be coming up here soon, probably at the end of July, early August. We'll have it completed, ready to go. It will be a 506c, so it'll be for accredited investors only. But that value add fund will acquire probably 3 to 5 properties. And the splits will be anywhere from 70-30 up to even 90-10 for high value check writers or for fund of fund managers.
Okay.
So yeah.
You said a couple things there. So you said 506c. Explain that and what's the difference between like some of those?
Sure. So I know it's a commercial multifamily or investment acronym, but so you have accredited investors, right? An accredited investor is somebody who makes as a single person 200,000 over the last 3 years, or a married couple over 300,000 combined over the last 3 years, or you have a net worth of $1 million, not including your primary residence, right? So all your renter properties, all your equity, all your, whatever you have as your net worth, right, has to be $1 million. For that, you are considered an accredited investor, right? Everyone else would be considered a non-accredited or a sophisticated investor. So a 506c is a SEC regulated securities, right? So that means that accredited investors only can invest in that property. And also, as a operator, I can advertise that property on social media, or however else I want to advertise for it, right? A 506b is for non-accredited. A portion of it can be non-accredited and also accredited, right? But that one is not able to be advertised in social medias and so forth. That has to be within friends and family, or with people who are known investors to you and your company, right? So I can't just go out and say like, hey, I don't know you, John, can you want to invest in our property? And if it's a 506b, that's against the law. So we are very ensure that our properties are all regulated. So we have lawyers draft all of our documents. The entity that buys a property, our investors are actually buying shares of that entity, or of that LLC. So they own a piece of the business that owns the real estate. And that's how the structure is done. All of our deals have what's called a PPM, which is a private placement memorandum. So I call it the Bible, but it's a 190-page document that basically tells you all the risks associated with investing in real estate, as well as who the general partnership is, what their experience is, and also what the splits are, the cash flows, all the different economics for the property as well too.
And
it's a
that's
mouthful.
that's per property, correct?
Per property, yeah. But the beauty about the fund that we're about to create, right, is that we'll be able to draft one set of documents, and that fund will actually go out and buy the properties, right? So we'll raise money for the fund, and we're going to go out and buy 3 to 4 to 5 different properties in different markets. So it's really good as far as diversification. So I am huge on diversification of a portfolio, right? I am not just going to buy 10 properties in Jacksonville that are all value add multifamily properties that are all the same economics. And so it's good, because if something happens to that market, we can't foresee when a COVID happens, right? Or which actually was pretty good for real estate, but in the aspect of another downturn, or if are we in a recession or we're not in a recession, whatever happens, right? So we are looking at different geographical locations, different size properties, and even different class properties as well too, right? So that way our fund is going to be very diversified, and be able to have a really good track record of returns for our investors, but also make sure it hits all the notes for our fund as well too. So if that makes sense.
What's your goal for the amount of money you guys want to raise in that fund? Or is there just like,
our first fund, we're looking to raise 10 million. So our first fund is going to be a $10 million fund. Again, that's going to acquire multiple properties. We're going to have really good economics for our investors. That way, the returns are going to be healthy for the investor side, which obviously, if we have great returns for there, we would hope that our investors would reinvest into our future funds as well too. But this will be our first one, our first fund, so to speak, right? Even though it's not our first property, it's our first fund, and so we want to make sure it's a good size fund. I'm not going to shoot for $100 million fund right now. That's going to be in the future. But right now we're looking at a $10 million fund to acquire those properties. And that's for the equity of the properties, right? So we get the equity of the properties, and then obviously we assign debt to it as well too. But that's going to be the size of the fund.
Nice. All right. So you kind of alluded on what's on the horizon for commercial. What's your plan on getting through that? Or are you just trying to raise a bunch of money to be prepared for the deals that are about to happen? And
So Yeah.
Like, what's the like
Oh,
overall like economic like possibilities with something like that occurring?
so so it's one of those funny things, right? Where I'm always like, oh, I'm behind the eight ball. I wish I would have invested 5 years ago, or 8 years ago, or 2 years ago, or 3 years ago. Where I think we're in a perfect position, right? We know that we're underwriting all of our properties for high debt, fixed rate debt. So we know that they're going to be able to make the mark, right, on that. And in the future, you see, no one has a crystal ball, right? But there's there's going to be rate cuts that are coming. We don't know when, right? I assume there might be one rate cut this year, and that's just going to obviously, spark a nice refinance ability for a couple other people who've gotten into deals that need to have that refinance ability, right? But we are going to underwrite our properties for a 5 year time frame, right? Where in 5 years we expect the rates to come down, maybe not a lot, right? But just a little bit, right? And the economy to kind of get rolling a little better, right? Job market's going to come up. We don't really see, like, personally, I mean, more about the rental, the single family home side, but I don't really see values of properties coming down all too much, right? They're kind of at a kind of a stagnant right now, right? Maybe they've dropped a tiny bit, but people are still buying. I mean, I live in a pretty affluent area of Maryland, and you can't find properties. Like, they're selling for over asking. One of my neighbor's a realtor, and she mentioned that she had 4 offers on a property just last week, right? So they're still battling for properties, even though they have high rates, right? But that's not everybody. Not everybody's able to afford the rates that we have today, or for the property values we have today. So what are they going to have to do? They're going to have to rent, right? So I think we're in a prime position for that. And I believe that it will correct in the future, right? But we're also value or looking at properties that might not appreciate in like the rental aspect, right? So the rent rates might be flat, right, or might be a tiny bit moving up a little bit with inflation. So we're not seeing 5, 10, 15% rent increases. So we're going to be very conservative on that approach as well. But I think this is going to be the perfect position to buy properties right now, that we're very conservatively underwriting them, buying them for a good price. So we think that the market's kind of settling out a little bit right now. So prior to this, early mid 23, late 23, sellers weren't really ready to drop their rates or drop their prices too much. Now we're seeing that happen a little bit more. So I think it's a good market right now to buy commercial real estate and specifically in the multifamily side. And like I said, even industrial, we just bought an industrial property in North Carolina. So we're excited about that one as well too.
Nice, that's awesome. So it kind of sounds like your goal for your company is to raise a bunch of money. How do people get a hold of you if they're interested in doing so?
Yeah, excellent. So I think the easiest way to get a hold of us is go to valoriscapitalpartners.com. From there, you can hit the connect or invest button, right, and pop your information in there, and one of our teammates will be in touch with you. We're also all over social medias: Facebook, LinkedIn, Instagram, Twitter, or X, I guess you call it, right? At Valoris Capital Partners, right, is our tag.
Can you spell that?
It's yeah, Valoris Capital Partners. And that's probably the best way to get a hold of us, or see our strategy, what we've done for our certain properties we've had, and so forth. So we have a lot of good activity on our social media. And then anyone can actually just reach out to me as well too, at Jeff Ervick on Facebook, or even LinkedIn as well too.
All right, perfect. Once again, I appreciate all your time. This is brought to you by Pinpoint Skip. We have single family and multifamily data. You can reach out to us at info@pinpointskip.com if you're looking for commercial data. And then for single family stuff, go to www.pinpointskip.com. Once again, I appreciate your time, Jeff, and let me know if there's anything I can help you with.
Awesome. Hey man, thank you so much. It's been a great time, and I look forward maybe to the next one.
Yeah, definitely. Thanks, man.
All righty.